Range trading is a slightly different style of trading, not tricky in its concept, but we need to make sure that there are certain conditions for us to be able to operate in. And there's some do's and don'ts that I'll remind people as we go through this session, and hopefully you'll see that it's something that we can actually add to our portfolio of trading strategies, when the time is right. So, what are the benefits of playing the range? Well, basically, they provide a trader with the potential to try and make money in a low volatility environment. And we'll see what I mean there when we move to identifying the range. And one other good thing about it is, given the way the strategy operates, is that we can actually deal with a reasonable amount of confidence because our stop losses are relatively close, and therefore our losses are generally quite tightly defined. So that's always an opportunity to add some leverage or allocate more capital to this type of trade. What do we need to consider when we are looking at this style of trading? Well, the market is constantly reviewing and receiving new information. And so we need to be constantly aware where there may be new items of data or price action that may change the environment that we're in and potentially see a breakout of these ranges, because it's at that point we need that clear stop loss protection, because basically the goalposts have changed and what we're trying to achieve, the opportunity may no longer be there. And the other side of it is these ranges can persist if we continue to have lower volatility. So there is a degree of patience that is needed, but sometimes these ranges can be quite big. So the benefits could well be worth that wait. Just a very quick one, and again, not a difficult concept. What is the range we're talking about? Well, it's trying to capture the price action between the support and resistance that can form when markets basically generally lose a bit of direction. We start meandering sideways, and these strong levels of support and resistance basically capture the market, stop it moving either side of it, and we're going to try, constantly this level of lower volatility. We're not breaking. There's no defined trend move up or down, and that's what we're going to try and capture from this strategy. We're going to pick up on oil as our example, and as you know, we always try and pick up-to-date markets. And just to give you an example here, we've got on the left-hand side the high of 92.70 on the 3rd of August, and we've got a low down there at 87, the figure, on the 5th of August. So it took 2 days to actually happen, but we've got a move there of 6%. So if we were in a situation where this, we'd identified this as potential range trading opportunity, going forward, if this were to continue to persist as a range, we have the opportunity, to maybe capture a good percentage of that range, and 6% over 2 days, I'll take that on any of my trades. So there's the opportunity available to us, but it does take a bit of patience. So again, just a couple of other things that may happen while we're trading this range. Here we've got the highs and the lows, the support and resistance. But as volatility decreases, what happens is these ranges may even condense further. What happens is those natural sellers on the top side and natural buyers on the buy side may be hedging. They have to do things by a certain time period. And they'll get eager to get these deals done. And what happens there is that they then have to bring it inside the range to try and get those deals done. So, you may see these ranges tighten a bit, and we have to be careful of that, because if we do, then we have to operate in a slightly different way and notice that maybe our parameters have changed and the amount of move that we capture is not quite there. The other side of it is, as well, is as we start moving potentially towards the end of a range, you may start seeing a slight bias in that range. And so in this instance, as we've seen, the top side is the only side that is coming down. And this may be because the buyers are quite comfortable to continue buying at that certain level, but maybe those sellers are reading some tea leaves that feel a bit anxious and they want to get this sell trade done, and they start bringing their offers down. And so that in itself may be giving you a bit of information as well. So watch out for that as these ranges persist. So quite simply, we do have this range, this support and this resistance. And what we're actually going to be doing is looking to play that range. One little thing I would like to stress, it should take a bit of time for you to recognize that this range is actually beginning to come into play. It's not always obvious. If you look at pure chartists, they probably want to look for 3 touch points on both sides to actually say there is a range here for us to take some advantage of. Because we're actually going to look at oil tonight, and because we're in volatile environments and not low volatile environments that generally these ranges occur in, we're going to have to accept that we're going to be jumping into this range just to showcase you some of the trading that needs to be done. But generally, they need to build before you actually realize that they are a range. And the other thing I would impress upon you is the first trade that you do within this range, I would suggest you go with the side that you probably fancy a little bit more. Generally when we trade in markets, we'll have an overriding bias as to whether we feel it, if it breaks out of this range, which side would it go, up or down? That will be to do with the fundamentals predominantly. And in this instance, we're going to go with the fact that we overall probably prefer oil to go higher. So we're going to start with a buy trade. And the reason you do that is because it could not be a range. You may have identified it wrongly. And so by buying, you're actually buying into your own bias. And what that will do is that will make you put this tight stop loss on. You have to do it anyway because that's the nature of the strategy, but it will make you do that because what you're saying is, if I had a choice here, I'd go long. And if it went down, I'd want to get out of that long trade. So on that break, I would want to put that tight stop loss. And it also is that feel good factor that you're long and you actually prefer that side. So what do? We get into that trade. We make sure we put the tight stop loss in. So it's going to be just below. Give it a little bit of move to make sure it's not a false break if it does go below that support line. And then that's our stop loss. Because if we break out of this range, that's our strategy gone. We should not be in it any further. We need to bite the bullet and just crack on and try and find our next trade idea. So in this instance, what we want is that we have a nice tight stop loss that allows us to put a bit more capital into the trade, because it's a defined loss. And then we want to see it bounce somewhere towards the top of this range. And at that point, we sell out. Now, in this first instance, you'll see we're selling out before we get up to the top. Now, that again is a personal choice. Human nature suggests we generally take profit too quickly. So again, I would urge that you have a little bit of patience, but in this instance, it showcases the fact that it won't always bounce right up to the top. And, sometimes if you sell out a bit earlier, you will capture that peak up there. And that allows you to be square because, again, you're selling out your long position. It allows you to be square. You see it all the way back down, and then it's eat, sleep, repeat. You want to buy just ahead of that support line, tight stop loss again, and you see it return all the way back up to the top. And it's at that point that you sell. Again, you sell just below that support line, that resistance line, because everybody's trying to play this trade. And you don't want to get involved with that bum fight trying to find the top of this market. Now, one thing, as this trade may persist, as this range may persist, and you get a bit more confident that it is a range, you may actually want to take the opportunity to capture both sides. So in this instance, once you've sold out your long position, and we've had 2 successful trades here, you can sell and go short and try and capture the move back down to the support level. And again, it's eat, sleep, repeat. You put your tight stop loss on, because if it breaks on the upside, you want to be out of that trade because it's no longer in a range, and therefore the trading strategy is no longer valid. So there's opportunities to capture both sides as and when you really feel that we are in this range. And that could be, showcased by shrinking Bollinger Bands, things like that, where it's telling you that volatility is still coming lower. So very briefly, we'll go on to this oil chart. We'll see how it plays out in real life. And what we actually managed to do here, we identified that range, 92.70, 87, the figure on the downside. Our protection is going to give it a bit of room to make sure that we don't get stopped out on a false break. So we're going to put our stop loss there at 86, the figure, and off we go. We have waited for a bit of confirmation. It's touched that base a couple of times, and we managed to buy our longs at 87.50. The market bounces. We've put our stop loss in, so we're protected. We move up to just above mid-range. And as I mentioned to you before, we're trying to capture that range. So a little bit of patience is required. It tops out a little bit, but then we see the nice sharp spike, and we managed to take our profit at 91.50. So, it's below that 92.70. We were maybe a bit anxious. We didn't want to see it try and ride all the way up to the top and miss that sell. We've sold at 91.50. 400 ticks. I'll take that any day of the week. We're now square. This is where the patience comes in. We're still not maybe overly confident it's a range. We see it go back down, and it starts going down to that support level. As human beings, again, we're going to get anxious, and we maybe buy a little bit early. And in this instance, I've got a purchase at 88.50. You're still closest to the bottom. What happens here is by, maybe getting in a bit too earlier, you're going to make your stop loss a bit more expensive. So you're going to add to your stop loss. You're going to keep your stop loss in the right place, which is that protection line at 86. But if you were to be stopped out, you'd be losing 250 ticks, as opposed to the first instance at 87.50 where we bought, where you would only lose 150. All valid, but I'm just showcasing that if you jump in a bit too early, as you see on this one, if you'd have waited again for 87.50, it would have come to you. But, there's no right or wrong on this. It's just that, one brings a lesser return if you get stopped out. Happy days. The market moves in our favor. We get back up, and we like the idea of selling at 91.50. It worked for us before. So in this instance, we've only picked up 300. If all our trades were only 300, we're in a great position. So what do? We get a bit more confident, and we think, do you know what? Now I think I can capture the downside. I sell at 91.50. It stopped on a few occasions there. It's proving to be a very valid line. What do I do now? I have to put my protection for that short position. So I put my protection a bit above that 92.70 support resistance line. So it's up there at 93.25. So now if it jumps through that level, I'm out of this transaction because it's broken the range, and I don't want to be in this anymore because my strategy is no longer valid. But clearly I want it to slip back down to that 87.50 level, somewhere like that, somewhere towards that support line. So as we play the tape out, typical as markets do, we've broken out that range. It could have been a piece of data. It could have been an announcement or anything. Once we trigger through that and it's not a false break, our stop loss gets taken out, and we jump to a high of 95.02. We dip a little bit, but we don't ever dip down to that previous resistance line, which will now naturally become a support line. So it's proved that all our stop losses and our levels were right. It's proved we're out of that range now, so the strategy is no longer valid. And what have we done? We picked up 400 ticks on the first range trade, 300 on the next, and because of our discipline, we only lost 155 on the third. I'll take any day 3 trades that accumulate me 545 ticks profit. And who knows, this range could have persisted and given you the opportunity to, play both sides 3-4 times. So, make sure you're on top of the news announcements, the price action, to see if it may be breaking out, because that may even have stopped you play that sell entry trade the third time round. but it's only lost you a little bit of money relative to the profit that you've made. So low volatility trade, identify it first, start playing those ranges, buy just above a support, sell just below a resistance. Important thing, tight stops.